Welcome everybody to another Deepvue webinar. This is going to be a fantastic one. We're discussing sell rules and using RME, relative measured extensions, to help identify when a stock is extended, might reverse hard, and this is a very key question, and it's very timely as well, because if you look at this chart, this, I'm sure, if you haven't been under a rock recently, you're aware of this stock, MicroStrategy MSTR. And this past Thursday, actually, look at this bar here. We were extended going into this, and then we had what we call a key reversal day, where we had a gap up and then just an expansion bar to the downside, undercutting a lot of these lows and retracing about 20-30% move all in one day. And this is something that can happen when a stock is extended. So this is why it's so important to be able to identify that when you own a position, especially in a highly volatile but strongly performing name like MSTR. This has been a tremendous trading vehicle, but if you're not aware that something like this can, be on the horizon, this can catch you off guard, take away all your profits, and even, put you negative if you entered a little bit late. So knowing when a stock is extended going into this and that this type of bar can happen, that's really valuable information and can help you manage your position and your trade that much better. Down here on the chart is the indicator relative measured extension that I developed for Deepvue, completely proprietary, not available anywhere else. And this helps serve as a guideline to tell you when a stock is extended to the upside as well as the downside. At the bottom of this base here, we had an extension to the downside. It pulled back all the way to the 200-day moving average. This extension indicator went all the way to -100. That's what happens when we're extended to the downside from a key moving average. And recently, as the stock has gotten extended and more likely to pull back, we're getting those warning signals as it gets all the way to +100. And this often leads to a pullback and can be a very sharp pullback, as we saw this past week. And don't worry, we'll get into all the settings, how to set up this indicator, all of that in today's webinar. But the key topic today is knowing how to identify those extensions and getting a little bit into the benefits of selling into strength versus selling into weakness. There's pros and cons to both, but hopefully you guys will have some really good and important takeaways from today's session. All right. So here are the key goals of the webinar that I pretty much just went over. First, discuss the pros and cons of selling into strength versus weakness. There's benefits and negatives to both, especially depending on your personal strategy, whether you're a swing trader or more of a longer term position trader. We'll discuss improving identification of extensions. As we mentioned, it's so important because we can, lose a lot of profits in one day if we are extended. And it's important to know if that is the case and take appropriate actions. And then also we'll be showcasing the relative measured extensions Deepvue indicator and how it can help you be more objective with your decisions. Every indicator we create has a purpose, and the purpose of this one is to help you identify objectively, hey, this stock is getting stretched from moving average based on its character, based on previous trends, all of that. Maybe it's time to be less aggressive if you're looking to add, or more defensive even, and take them off the table when we do get to those extension levels. And a big benefit of this indicator as well is that you don't have to hard code in an HER value from a moving average where, some stock might reverse hard at 5 HER, some at 7, some at 10. The benefit of this is that it's on a relative basis. It's oscillating between -100, which is extended to the downside, and +100, which is extended to the upside. And there's no hard coding needed. All you do is input the moving average you want to use, and Deepvue basically trains itself on that moving average and on historical movements around that average to give you a very timely as well as objective opinion of extension. And we'll get into much more details on that point. Here's a little bit of our agenda. First, discussing position management, the art of trading, then getting into selling to strength, selling into weakness, some guidelines there, trading around a core, which is a lot of kind of a blended approach of these two, and a lot of market wizards adopt this because it kind of juices performance. Then we'll discuss extensions in general, the relative measured extensions indicator, which can help you identify those extensions, get into a lot of examples, and then do a live demo in Deepvue. So hopefully you guys are pumped for this, and I think this will be a fantastic webinar. So thank you for spending time here with me this morning. All right, and before we get into it, I do want to mention that we're having a special offer, our best price ever, and this will be never offered again. We have a special Deepvue Black Friday offer. To access this, you want to email hello@deepvue.com and mention Black Friday for details. This is available if you've never signed up for Deepvue before, or if you're a current monthly or annual subscriber. Basically, you can lock in as many years at our lowest price ever as you want with an upfront payment. And this is a great deal to lock in savings going out into the future. We've had members who have locked in 4, 6, even 10 years already using this deal. So go ahead and email us at hello@deepvue.com if you're interested. And I would highly, highly recommend this. And this is available for a limited time only. All right. So getting into it, position management, the art of trading. What is position management? And let me move this Zoom toolbar down here. Basically, position management is the system you use to decide when to hold or sell a trading position. So you put on a trade, how you decide now, all right, when will I take profits, whether into strength or into weakness. I see a comment from Chad. My girlfriend just got me Deepvue as a Christmas present. There you go. That's a perfect gift. So that's great, Chad. And your girlfriend's a winner. I just want to say that. All right. So getting back into it, position management. This system that you develop and how much you sell into strength, how much you sell into weakness, there's some really important factors that you want to consider. First, it should align with your trading style. If you're a day trader or swing trader, you're likely going to be more in tune with selling into strength and selling near peak equity highs and just getting your piece of a strong move versus trying to hold until the stock shows weakness, because at that point it could decline and take away a lot of your profits. And for swing traders especially, selling into strength is probably more suited, and we'll get into that. Versus if you're a position trader, you're more likely to be using sell and weakness rules, which is more in tune with that trading style. Second, the market environment. Depending on what type of market we're in, whether we're in a trending market, a choppy market, an uptrend, a downtrend, that's going to favor selling into strength or selling into weakness. In 2021, breakouts weren't holding, they weren't following through. So you really had to sell into strength and be much more aggressive with that versus trying to hold for a nice trend like we're seeing here in 2024, where a lot of people are making a lot of progress because breakouts are following through, earnings gap ups are following through, and it's just more suited towards a longer term hold versus other different markets. So really paying attention to if there's follow through in the markets gives you a sense of which style you should be leaning more towards and how aggressive you should be with selling into strength versus selling into weakness. Then, and I think this is often overlooked, even if you're a position trader, if you're trading a stock that is very whippy, is maybe a really strong performer, but likes to pull back and its character is to pull back 20% in a day, you probably should consider selling into strength that position versus trying to use your typical sell rules. And that's because the character of the stock is much better suited to that style versus imposing your system onto a stock that's not suited for it. So really knowing kind of what type of stock you're trading, whether it's a whippy fast mover or a stock that just loves to just trend and trend and trend. Maybe it's not the fastest mover, but it's a very consistent mover. Knowing what you own and what you're trading is really key and can help you decide for an individual stock whether you're going to be selling into strength or selling into weakness. Then your entry point and your profit cushion also are really important consideration. And this can help, gear you towards, is the market a good trending market or more of a sell into strength market? Because if you buy a base breakout, the stock moves up 30% in a week, like we've seen previously, in recent weeks, you've got a great profit cushion there. And even if you're a swing trader, that show of power, especially from an early stage base, could suggest that there's a much longer trend about to happen. Like we saw with, App, it had a fantastic breakout and then went on and doubled from that. So that type of power is something to key in on. And if you've got that profit cushion early, maybe you want to consider, holding for a longer term move, using moving averages, looking to sell into weakness more versus just selling into strength because, the market and the feedback from that individual trade has shown you that that stock has potential. And this is really important because your profit cushion and the type of stock should help inform you with how you manage a trade. If you buy a stock on, an inside week, in the middle of nowhere, that should be more a sell into strength type situation versus buying an early stage base breakout in a really promising IPO, that just had and then has an earnings gap for you. Your profit cushion and where you buy the stock also should be a factor. And then you've got the art of selling, of course. So, this kind of brings everything together. There's two choices: selling into strength, selling into weakness. There's a common saying that if you don't sell into strength, you're selling into weakness. It's 100% true. And there's pros and cons to both of these, as we'll get into. But I think these 4 points aren't often discussed and are really important to help inform you about what style is best suited for you and the situation. All right, so first, getting into selling into strength. What is it? Basically, it's when you're selling as the stock is still rising and moving higher for you. And this can be based on a risk multiple from your entry. Maybe you're up 3 times your risk. Maybe you're up 5 times, 10 times your risk. Those can be levels where you want to take profits to make sure mathematically you're going to have positive expectancy and move your account forward. It can also be based on an extension from a moving average, such as the 10-day moving average, the 20-day, the 50-day, even the 200-day moving average. That can all be reasons to sell into strength. It can be based on a percentage move from a base, just noticing euphoric price action, such as many gaps in a row, an acceleration in the trend of an uptrend. And then lastly, the stock could be approaching a very key level, whether it's a Livermore 500 level, 100 level, or previous resistance looking to the left of the chart. That can be another reason to sell some into strength in anticipation that the stock might respect that level and start to pull back and decline and maybe set back up, or just kind of maybe roll over and start a downtrend. There's kind of 2 main pros of selling into strength. First, your equity curve is staying right near all-time highs. If you're selling as you're making profits, your equity curve is going to be right near all-time highs, and then you can take that profits and reinvest them into the next fresh opportunity. And that's actually number 2 here. It helps you kind of compound a little bit faster, especially if you're a very talented swing trader. You can, swing something for 20%, take that gain, move it into the next fresh breakout, swing that for 10% and compound that way. Obviously, there's always going to be losses in there, but that's kind of the general idea. But the cons of this is that you're often not getting the full trend, and you kind of have to accept that as somebody who's selling into strength. You're going to cut off some names that are going to go up double, triple, 10x, but you're just kind of getting your relevant piece of that trend. And the second con here is that you have to find another trade, and you have to kind of start the whole process over of, your initial position. Am I going to get stopped out for a small loss? There's a lot of decisions to be made there. So that is a con with the strategy, is you have to find a fresh setup. You have to, use your entry tactics all over again. And there's a possibility that that next trade will be a failure, and, you would have been better off just sticking with that original trade. But with every strategy and every decision you make with trading, there's going to be these trade-offs that you have to think about and decide, even though these are the cons, this vibes a lot more with my style, the kind of stocks that I like to trade. So some guidelines here for selling into strength. I think this is really best suited for swing traders who are just trying to capture quick moves and find the next trade and try to compound that way. It's also best suited for choppy market environments. So if stocks aren't following through, they're only going 2-3 days and then reversing hard. That's also a situation where it would favor swing trading and selling into strength. Also, the stock, in order to sell into strength, the stock should be visually extended from your ideal or proper buy point. That's just a rule of thumb. We want to play the expansion from the contraction, as I'm sure many of you guys heard me say, 5 million times yesterday in the relative measured volatility webinar. But basically, you're trying to sell into that expansion and profit from that expansion move from the tight area, whether that's near a new base, near a moving average pullback, whatever the situation may be. Also, as I mentioned, another reason to sell into strength could be nearing a potential resistance line, an upward trend line. A lot of people draw trend lines near the upside of this trend. If you kind of visualize this on MSTR, let me actually zoom in here. If you drew a trend line connecting this high, this high, this high, this one's a little bit lower, you can see that, the action last week marked an acceleration of the trend. And right in this area, you're extending above that trend line that we can draw. And that can be another reason to sell some into strength. A lot of fantastic traders, Stan Druckenmiller, he uses that as a sell signal. He's used that to kind of, I think, sell Tesla in 2019 right before the reversal down. So that's definitely a valid reason to sell some into strength. Also, if you're just kind of, swinging it from the bottom of a base to the top, when we approach those prior highs or the base pivot, that can be another reason to take some off, because often there's a pullback or volatility right near that base pivot. And as a swing trader, you don't want any part of that. You just want to take, your gains and run and move on to the next setup. Then, as I mentioned, you could sell some into strength based on a multiple of your risk. And then lastly, another reason to consider selling some into strength is, if the rest of the stocks in this group are also getting extended, the market is also getting extended after already being in a trend for quite some time, that can be, a sign to take some off the table to try to keep your equity curve as close to all-time highs as possible. Maybe the market goes a little bit higher after that point, but if you protect yourself and avoid, big 1-2 day drops later on in the trend, as a swing trader, that's exactly what you're trying to do. You're trying to limit your downside and just, keep your equity curve as close to highs as possible. All right, so selling into weakness, the other side of the equation. This is basically selling as a stock is breaking its trend. And there are many ways to define breaking an uptrend. It can be a break below a moving average. It can be a break of market structure. We go from higher highs and higher lows to then forming a lower high and lower low. That can be an objective way of defining a break of trend. It can also be, when there's a failed breakout. So there's a late stage base. There's a lot of these in 2021 that you can go back and study. If later in a trend, a stock breaks out of the base and then just reverses right back hard, that can be a sign that, hey, weakness is happening. There might be a downtrend and you could take some chips off the table. Pros with this is that selling into weakness means you're going to get most of the move. You're going to stick with it until the end, until it breaks a trend as defined by your trading style and your time frame. That could be a weekly uptrend, that could be a daily uptrend, it could be using a 50 SMA versus a 21 EMA, whatever you define for yourself and what helps you for your time frame. It helps you stick with that trend and get the meat of it. You'll have some really asymmetric winners that go up, 20 times, maybe even 50 times your initial risk. And you're really kind of capitalize on that, versus swing traders are just trying to turn over their edge and get a lot of 3 to 5x risk multiples. It's kind of the trade-off between the two different styles. And another pro of this is that because you're sticking with that longer term trend, there's less action and more clarity about when the trade is over. With a swing trader, you could always say, hey, I want to hold longer, get more of the expansion. With a sell into weakness, it's pretty clear when that trend is ending, and that's when you get out. And I think this key here, less action, is really, really important. And why I say that is because many of you watching this are probably doing this part-time while working another full-time job, and you're not able to be watching everything, all your charts every minute of the day, even though you may want to. So having less to do and less signals, you set your alert at the moving average that if it breaks that, you're out. It offers a lot of clarity, peace of mind, and less trades overall. And that can be a huge benefit and a huge positive for people trading part-time. So I do want to kind of emphasize that for people who work full-time and do this kind of on a part-time basis, selling into weakness is probably the way to go. The cons of this is that because you're waiting for a break of the trend, by definition, there's going to be a move off the highs. And that means that your equity curve will be off highs as well. So you want to make sure that, that suits your style enough that you're willing to give back some profits to, have a trade-off of potentially sticking for a longer term move. All right. Let's see if there's any key questions here just yet. Coleman asks, would it be fair to say RME is more useful for a swing trader than a position trend trader? I think it's useful for both. And that's because as a position trader, you just want to use different moving averages, and then you can kind of know when to expect. Maybe we'll have weakness and we're really getting extended from the 50-day moving average. And in those special situations, you might want to sell early, but we'll get to that there. All right. So let's keep moving. So some guidelines for selling into weakness. And let me move the zoom thing. So selling into weakness. Again, this is, I think, best for position traders, part-time traders. I personally use two closes below the 21 EMA as my sell into weakness cue. It works fantastic for trading kind of moves from base to base. We've got Nvidia here. It trends above the 21 EMA for quite some time, and then finally here we close twice below the 21 EMA. It helps me sit out during this base, get back in up the right hand side, and play that next move from base to base. So two closes below the 21 EMA is a fantastic for kind of intermediate traders. You can also use the 50 SMA if you want to hold a little bit longer. It all kind of depends on what suits your personal style. Guidelines, this lets the trend work for you. Again, you're just kind of sitting with the stock and letting it do its thing. Letting it do its thing. If it works, great. If it reverses down, it's a very clear signal to get out. And clarity is really, really helpful in trading. And this is especially good when you have a significant cushion. You get peace of mind, and you just have to kind of check in every day or every week and say, is the stock acting normal? Is it above the moving averages? Is it just having normal pullbacks, corrections that are holding above the moving average that I'm using? It's very easy to decide, I still want to be in the stock. I still think it has potential, and you'll be able to stick with that longer term trend. And I think this is a really helpful quote that I'm paraphrasing here from Jesse Livermore. It was the sitting that made me the big money. Trading didn't. It was sitting with those longer term trends. And that's so important. All right, so we've talked about selling into strength. We've talked about selling into weakness, but there's always the potential for a blended approach. And this is what a lot of the market wizards end up doing. Mark Minervini, Oliver Kell, these fantastic traders that put up triple-digit returns. They often use a blended approach among their core positions. They have a core position and a very high potential stock breaking out of an early stage base, and they sell a little bit when it gets extended, add back on the pullback, sell a bit when it gets extended, add back on the pullback, and play that longer term move with the core, but kind of manage their position by selling some to strength of partial, adding it back. So they're able to sit through those drawdowns because they have the benefit of knowing, hey, I've already locked in a little profits. I can add it back later. So this is what a lot of the market wizards do. And basically, it's what I said just now. As the stock gets extended, you sell some, wait for the next lower setup, add it back, sell in an extension, sit through the base, add it back as it pushes higher again. And this is kind of the best of both worlds. It does mean you're going to have a little bit more of an equity curve drawdown because there will be a move off highs that ultimately ends the trend. But this can really help maximize a market leader move and maximize time as well. Because this allows you to maybe sit through a base with your core, but then be focused on other names that are working with that extra capital, and then finally add it back when the market leader starts moving again. The cons is that once again, more trading is required, and more actions and decisions and attentiveness is required to do this really successfully. And this is really an art here, selling into strength, adding back on weakness at the next lower setup. And you really have to be much more experienced to do this effectively. So I think initially, my recommendation would be start with selling into weakness, and then you can, spice things in and try to, improve your selling into strength as well. And then eventually get to kind of this blended trading around of a position. So here's an example with RKLB. Like I said, you've got an extension here. You can sell some into strength. It then pulls back to the 21 EMA, tightens up again. Inside day on very low volume. You add back the position on the breakout through this pivot. Play this expansion move, sell some into strength, hold that core, add some back, sell some. None of your buys and sells are going to be perfect, but you're basically looking to optimize. So during the pullback periods, consolidation periods, you don't have your full position, and then you add that back once it starts a new expansion period. So that's the goal with trading around a core position. All right, so let's get into kind of the second part of today, and let me get a quick drink of water here. How do we know if a stock is extended? When do we know to sell some into strength? Well, basically what you want to do is decide, is it visually far from the moving average based on its character? And for swing traders, you might be using the 10-day, the 20-day. For position traders, you might be using the 50-day or also the 20-day. It kind of depends on, again, your style and what you like to use. And kind of visually seeing if it's far from moving average, it is subjective. And that's kind of the whole point of relative measured extension indicator, is it adds objectivity to something that was previously pretty subjective and required a lot of practice, a lot of experience as well. William O'Neill, of course, could find climax tops just visually right in, in 1 second because he studies so many, but newer traders often have a very hard time at this, and that's why we developed this indicator. And even if you're more experienced, it can help kind of confirm what you're already seeing by objectively saying, yes, this is a little bit extended from a particular moving average. Also, I do want to mention, it's really important when deciding if a stock is extended to consider the wider context. If a stock is just breaking out of a 1 year base and gets extended off its moving average, that's not a negative. That's a huge positive. That shows that there's power behind the move and that institutions are likely just starting or continuing to add aggressively to their positions. And that likely means that a longer term trend is in store. So an extension that happens very early on in a move is very different than an extension that happens after a stock's already been trending 6, 8, 12 months. So that's really important. I do want to really mention that today is you don't want to treat all extensions the same. And an extension at the initial start of a move is actually a very strong positive, and maybe tells you to focus more on that stock on the next pullback to add back or even add to your initial position. So where's the stock in this move? That's really important. So is the extension a show of early power? That's what you want to consider there. Also consider, are we in a strong market? Are extensions being worked off based on consolidations? Are they reversing really hard? Are we in a choppy market versus trending market? That's what we're discussing here. And also this last point, are we extended on the weekly chart or just on the daily? Again, if we're just starting the move, we might be extended on the daily chart, but everything looks completely normal and the move might just be getting started and catching momentum on the weekly chart. So it's really important to not just consider the daily chart when discussing are we extended right now, but also taking a look at the weekly chart and see if that confirms your suspicions. Extensions, why are they important to identify? Sorry for the typo here. Early in the move, as I mentioned, it's actually a show of power. So that's why you'd want to identify them early on, because that shows you, hey, this stock could become a leader. Later in the move, you want to identify extensions because there's an increased risk of large reversals down and sharp pullbacks like we saw with MSTR, as we'll take a look again later on. Also, identifying them helps you know when to avoid adding. One of the biggest mistakes that newer traders make, and this comes from talking to hundreds of traders out there, is they add when a stock is already extended. And then, the stock pulls back just in a natural correction. They get stopped out, then it carries on without them and goes up 100%. And they miss the move. And why? Because they weren't entering from a contraction. They were entering as a stock had already expanded. It was extended from the moving average and it was powerful, but their timing was just a little bit off. So knowing when a stock is extended is really helpful for timing your ads, timing your initial entries. And I do want to emphasize this, extensions can resolve in two ways, and we'll kind of see this with the examples. They can resolve based on time, and the stock just kind of trends sideways, consolidates, and kind of works off the extension, lets the moving average catch up to price, or they can resolve based on a price decline, a pullback, a sharp drop. And that again, brings the stock a lot closer to the moving average. So those are the two main ways. A consolidation based on time, that is the more constructive type of pullback. But the price pullback is definitely a reality as well, especially when a stock gets very, very extended like MSTR. And in general, identifying extensions helps you have a mental picture and expectation of what can happen next. And that just helps you stay informed with where you are in the market cycle. It tells you how you should maybe be thinking about managing your position. Hey, we're getting really stretched here late in the move. I want to, look to sell to strength on the next gap up. Or, hey, we're extended, but we're pretty early on. We just broke out. I want to sit through the next natural pullback because I think this stock has good fundamentals, good theme, and is just getting started on the daily and weekly chart. So identifying extension just helps improve your chart eye and helps improve you as a trader and your system and your process. All right, so let's get into indicator here. Let me see if there's any key questions here. Yeah, cool. All right. Let's see, relative measured extensions. So this indicator basically is trained based on a lookback period to determine what is normal versus abnormal as an extension from a moving average that you select. There are two different inputs. You want to enter the moving average that you want to use, and then the look back period that you want to train Deepvue on to look for extensions above or below that moving average. The indicator itself oscillates between negative 100, which means extended to the downside, and positive 100, which means extended to the upside. Neutral is anywhere in between. Zero is the neutral line. And you've got these adjustable red areas here that you can decide, your danger zones, extended to the downside, extended to the upside. Useful settings, and these are kind of good to initially start with, and then you can tweak to your own liking. For position traders, I really would recommend the 50 SMA 250-day look back. Basically, it trains Deepvue on a year's worth of price action about the 50 SMA to determine what's extended or to the upside or downside based on that moving average. For swing traders, you can use the 20-day and then 100-day look back, or 10-day 100 look back. This will give you faster signals, but still call out key extensions from those moving averages. And then for very fast traders and more aggressive swing traders, I might even recommend a 10-day moving average and then a 20-day look back. This will give you much more sensitive readings about oscillations above and below. So it will kind of point out, much more local extensions above and below a moving average. So this will be really good for fast signals and for fast traders. And we'll go through a few examples here. So let's talk through the indicator on the chart here. This is the QQQ. Here you've got the danger zone in red to the upside. Anything in this zone is getting pretty extended to the upside. Here you've got the danger zone to the downside. This is where base lows happen and a stock basically has a higher chance of a reversal up and the start of a new trend. So here with the QQQ, if we follow it to the right side, it is extended in its trend for quite some time, but then at the very peak, we see another extension. And this is where context matters. Early on in a trend, this might be a show of power, but later on in a trend, you want to really be paying attention to this in terms of the market and saying, hey, we're extended on the market. I might be, more attentive to my positions and be more defensive if we start reversing down, because we could start a new correction. So we get extended, we move down, we have this correction, and you can see we get a little bit extended here, we reverse up, and then we have one more leg down and really get below that moving average and get all the way down to negative 100. And this is where base lows and reversals happen. This marked the low of the correction. It's amazing how precise this often is. And we started a new uptrend right after that. Then you can see we got a little bit short-term extended early on in the trend, but this was a show of power. Again, context matters. And then later on, you can see we just start trending. The rate of ascent declines overall, and there's no kind of actual signal to the upside that we're getting too extended. This one just kind of loses steam and rolls over, which can certainly happen. We have another base low that happens in the danger zone. Later on, again, we get an extension here and here. We reverse down both times. This one ends up being the top for that correction, and then we get a really sharp decline. This is why this danger zone can help serve as a great guideline to say, hey, I want to be more defensive, especially if the market leaders start breaking down as well. So this helps kind of put you in the right mindset and situational awareness. Then again, sharp decline, reversal happens right at negative 100, and we start the next move higher. So this is kind of how you interpret RME in this danger zone, and you can adjust this to be higher up if you'd like. This is when you want to start, being a little bit more defensive. And then to the downside, it's not that you're being aggressive here and buying and putting all your account on margin. Instead, you're just having the mindset that, hey, we're extended to the downside. I should start looking for signs and building my relative strength lists and being ready if the next uptrend kind of materializes. So that's how you kind of want to interpret RME. Here's the market. We just kind of went through this as well. I won't do it again. But basically, the key thing I want to point out is for analyzing the QQQ, this is an extremely good indicator for finding spots where the market low might be in. And then we're looking for confirmation from market leadership, the follow through day, whatever your system is. But, having this go to negative 100 is a sign that, hey, I really need to be focused now. We could be starting a new uptrend. I want to be ahead of the curve and really, what leaders I want to buy, breaking down the bases if we do start a new uptrend. So this can put you ahead of most of the competition. So here's an example with Nvidia itself. It also marked the base lows here, right here. This pulled back into the danger zone, base low again, back in here, again, base low here. And also the extension here, you can see another key reversal day happen later on in the trend. It also showed an extension here we got a pullback, we had another earnings gap, got extended again, pullback, extension again, and you can see it marked, extensions throughout here, but this just gives you, this puts you on the right track. It's not going to be always so precise because stocks can stay extended for an extended period of time, but it puts you in the right mindset that, hey, I don't really want to be adding here, we're extended. I would, much rather either sit with my position or be more on guard or even selling some into strength if I'm a swing trader. So it puts you in the right frame of mind, and that's kind of the goal with this indicator. No indicator is infallible. You always want to consider the full context of the chart, but this one is pretty good for helping you stay, as I said, in the right mindset. Here's another example with app. We had some extension here after a gap up. We consolidated, continued to trend higher. Then we started a base here. Where does the base low happen? Right at negative 100. We start the uptrend. You could have entered, through the moving averages or been really ready for this pullback here. We get a nice powerful move higher. We get short-term extended, but here we pretty much consolidate based on time here. We pretty much go sideways after this extension. But we had the recent gap up. Again, we got extended here. This doesn't mean the run is over. Just in the short term, risk reward isn't great. We do get a slight push up here, but more of a short swing trade type setup. We're longer in the tooth in terms of the trend. So again, this puts you just kind of in the right frame of mind that back in this area, a reversal might happen. Back in this area, should be more on guard, a little bit more defensive. Here's app with a different setting. So here we've got the 50-day moving average is what we're using, the 50-day, and then the 250-day look back period. And let me zoom in here actually. Let's go to the last slide. Let me zoom in. So right here next to the indicator tells you your settings. This first number is the look back period you're using. And the second period, the second input here is the moving average that you're using, a simple moving average. So this is a 250-day look back period on the 50-day moving average. And this is the value of the stock, this indicator basically on the day that I'm pointed at currently. So here we've got a different look back period. We're using a 20-day moving average and a 100-day look back period. So it's going to be a little bit more sensitive. Calls out this extension, pullback. So just kind of play around with this and see what settings work best for you. Do you want faster signals? Do you want slower signals? And you can kind of start with the recommendations that I have and then kind of tweak it to suit your own personal style. Here's another example with MSTR. We've got a 100 look back, 20-day moving average. It points out the extensions here where we pull back. We get extended here, but kind of continue higher because, like I said, stocks can stay extended for quite some time. Then you've got the base low here. And then recently, each of these pullbacks corresponded with an extension on this indicator. So it can help you, especially when swing trading this. Here's our closer-up view, and this is using a 10-day moving average, 100-day look back. Again, a little bit more sensitive. So for swing traders, this might be really useful. And you can see how we got extended right throughout here. So that's where the expectation that a reversal day like this could happen should, pop into your mind, and you should be ready and on guard, raise your stops, be more aggressive with selling gaps, all that type of thing. Here's an even faster setting. You've got the 10-day moving average, but then a 20-day look back period and just much faster signals. And it kind of catches each of these tops here really nicely to know to expect that pullback. Here's RKLB with a 20-day moving average, 100 period look back. It catches these peaks really nicely. Again, just an expectation that a pullback may happen. Then you can look to add back that partial or, re-enter if you're a swing trader. And it just does a really nice job of catching, where you might want to be taking profits and looking to re-enter on the pullback. Here's Tesla. Again, same thing. This is using a 10-day moving average and a 100-day pullback or look back period. Catches these peaks really nicely. And recently you had a very sharp pullback, which I was expecting because of this indicator. Everybody was euphoric. It was breaking out of a weekly, weekly base here, but it was extended going into that level. And that's the type of situation where you want to be aware of that and know that a sharp reversal, sharp drop can happen. So, you're either selling into strength, looking to add back against the 10-day moving average, or just aware mentally that, hey, things have been going really well, but, I don't want to be too happy because we could have a pullback, and I just want to be aware of that possibility. This type of action doesn't just hold and keep on going forever. Otherwise, we'd all be rich. So these pullbacks happen, and this helps you kind of stay in the right mindset and knowing when that might occur. And I actually kind of called this out live using this indicator. So this is a great use case. And going back in the past, you can see many instances where RME points out, the extension, we get a reversal, new base, pullback, whatever. And, this happened, right in this area. That's when I posted this tweet. So it's not hindsight analysis. This is something you can use in real time as you're analyzing market leaders and the market. So some key reminders with RME. Extensions are a natural part of a stock's price cycle, and they can be a great positive early on in a move. From a fresh breakout, all of that, it's when you get more extended in the run, longer term in the trend, that you want to really be paying attention and be ready for potential large reversal days. Always consider the full context of the chart, and RME helps provide an objective view whether stock is extended. There's a lot of people who say you just kind of want to look visually and say, all right, it's about as far as from the moving average as where it's reversed last time. RME kind of takes the guesswork out of that and just gives you a very simple visual representation of, hey, this stock is extended. I might want to be more defensive. And I also want to remind you that stocks can stay extended for quite some time. Just because this indicator says it's extended, the stock might get even more extended, as we see in parabolic runs all the time. All that's telling you is that the odds of a pullback are increasing when RME says a stock is extended. So always, again, consider the full context of the chart and be ready for anything, because anything can happen in trading. So let's see if there's any questions here that I want to cover here. Yeah, good question, Justin. So his question is basically recommended RME settings for stocks as they're gapping out of earnings. When you have a strong earnings gap, by definition, the stock is getting extended. And that's why we often have a flag out, a pullback, to the 10-day moving average. So you kind of just want to use your normal settings, but consider that, that is a sign of strength. That's a positive, especially if it's the first earnings gap. So you're not just looking to, sell immediately, depending on your costs and all of that. But that can be a great spot to focus on later on to catch, a pullback buy, pullback to the 10-day moving average, a tight area breakout, whatever the entry tactic is. That can be a great stock to focus on because it's already shown that power with the earnings gap. Let's see here. Coleman says this was excellent. Thank you. Can we look at without prior to Thursday for MSTR? Yeah, we can go back in time for sure. So basically, to plot RMV and Deepvue, you need to have enough information to train RME on that stock. So if you're using a look back period of 1,000 bars and the stock hasn't traded 1,000 bars, you're not going to be able to plot that RME. So you have to choose a configuration that works for a particular stock. So whether you're looking on a weekly chart, many weekly charts, of newer IPOs don't have 250 bars. So make sure you're adjusting the settings, whether you're looking at a daily, weekly chart to make sense for what you're plotting. All right. For the settings for QQQ, I like to use a 50-day moving average and a 250-day look back period. Yeah, GEV and ALAB are recent IPOs. That's why you can't get RME with all configurations just yet. So it has to trade a certain amount of time to basically work. Joe asked, do you use base counting for this? Base counting is a great way to determine whether a stock is long in the tooth and the trend is getting a little bit more stretched. So definitely you can combine that with RME to say, hey, if it's coming out of 4-stage base and getting extended on the daily and weekly, that would be more of a time to sell into strength versus if it's getting extended from a stage 1 base. So great question, Joe. All right, perfect. Stupid question. There's no stupid questions, Francois. Do you use RMV in conjunction with RME? They look for completely different things. So RMV is looking for contractions and expansions. RME gives you a sense of whether we're extended above or below a moving average. So they both kind of show expansions, but are looking at different things. So you can definitely use them together. And, if that helps your analysis, go for it. All right. Alex says, really nice tool to get awareness in an instant. I like it a lot. Awesome. All right, so let's go ahead and show a demo. But before we do that, just want to remind you guys that we're doing the Deepvue Black Friday. Here are two, testimonials here. To basically access this, you can go to deepvue.com if you're not a user currently and you want to lock in an annual rate or get the special $390 a year for 1 year. You can go ahead and do that. If you're an existing monthly or annual subscriber, don't go ahead to deepvue.com and purchase the Black Friday deal. Email us at hello@deepvue.com and mention Black Friday and let us know how many years you would like to lock in, and we'll go ahead and process for you on our side. So definitely go ahead and take advantage of this. Highly, highly recommend that. We're building new features every single week, and it's going to be amazing, all the stuff we bring to you guys next year. So definitely go ahead and take advantage of this. I highly recommend it. It's the daily tool I use every single day to trade, and we're building in so many exclusive proprietary features that help you save you time during screening, find leaders faster, execute better, manage positions better. That's what Deepvue is all about, is being kind of the ultimate trading assistant. So if you're interested in that, and we incorporate user feedback, every single day, go ahead and check out the Deepvue Black Friday offer by visiting deepvue.com or emailing us at hello@deepvue.com and mentioning Black Friday for details. Also, I do want to mention as well that at TraderLion, we've got so many amazing masterclasses with top traders: Oliver Kell, Leif Serede, Stan Weinstein himself. John Boyk gave an amazing historical analysis masterclass. Jared Tendler covering the psychology of trading, that side of things, very complementary to any trading style. These are the best trading education classes and courses you can take. We've worked extremely hard to make these as high value as possible, especially for the price. And I'm interested to know, for anybody watching here, have you guys taken any of these classes? And let us know your raw feedback on that. Did it help your trading? Did it teach you new techniques in terms of buys, sells? Let us know in the chat so people kind of can see some feedback from real traders who have taken this class. Here from PBA, Jay, Oliver, and TraderLion are changing lives. Took me 20 years to figure this out. Yeah, this is about the Swing Trader Masterclass with Oliver Kell. So, I think these are tremendous resources. These are great deals, great sales that are going on right now. If you want to have an amazing 2025, take advantage of this. If you haven't taken any of our masterclasses before, I'd recommend the Oliver Kell Swing Trader Masterclass. That's a great one to start with. And we're seeing some great feedback here. Oliver Kell, very good. John Boy's class, A+. High Tight Flag Masterclass, excellent. So thank you guys for sharing your feedback. Definitely appreciate it. 100% worth it. Very nice, says Glenn. Very nice. Yeah, great to hear that we've helped you guys. And that's what we're all about. Deepvue is kind of the ultimate trading assistant tool. TraderLion is the education that can help you learn all these strategies from these proven traders. So definitely check these out. And we have a special benefit. If you're interested in the Swing Trading Masterclass flash sale, we're doing an extra $100 off. The last day is today to take advantage of this. And basically all you have to do is use the code extra100STM at checkout, and you'll get that extra 100 off. And it was already a great deal, and this even makes it, this makes it a steal. So if you haven't taken the Swing Trader Masterclass, it's an amazing resource. I rewatch it every single year, and you just have to go over to checkout, traderline.com/university, click Swing Trader Masterclass, and then enter this at the checkout, and you'll get that extra 100 off. So highly recommend this. This is a fantastic, fantastic resource. So with that, let's go ahead over to Deepvue here, and let's go ahead and have a quick demo here. So first, let me kind of clear out everything. Let's start from scratch. To add the indicator to your chart, you want to go over to this icon right here, Indicators and Strategies. This is where you find all our indicators. Give that a click. Type in DV, and that brings up all the different proprietary indicators that we have. We have so many to check out here, and you can either just find it like right here, or you could also just search relative, and it will pop up as well. So that applies it to your chart with the default settings of 50-day moving average and 250-day moving average or look back period. Let me get a quick drink of water here. All right. So by default, we have, if we go open to settings, and you do that by hovering over it, clicking the gear icon, And this brings up where you can change the look back period as well as the SMA length. So if we look at this, we've got 50-day here, look back period of 250 days. Again, this is good for position traders. It still identifies, key extensions like the one in Tesla recently, but is a little bit slower of a signal and better suited for position traders. But if you type in this to, let's say 20, and change this to a 10-day moving average, this is now using the 10-day moving average and is much more sensitive to find these shorter term extensions and tops. So this is better for faster swing traders who want more of a signal and more action overall and kind of to juice their returns that way. Let's go ahead over to Duolingo here. This is a good example of a base low as well. We get extended, but stay extended for quite some time. Then we set up a nice pullback. We get another actually base low in here as identified by this faster signal. We get extended again. Right here, we start a new base. And you can see how this configuration, 10 and 20, gives you a much of a faster signal and more suited for swing traders. It points out this extension. This is more the proper buy point back in this tight area. And again, we're getting extended. So we might have an expectation of a short-term pullback next week. Let's go to PLTR. So here we've got the earnings gaps. We get extended, we stay extended, but then start to work things off here. Back in this area, we're extended off the base low, extended after the breakout as well. So again, this is just a faster signal and helps you spot those more intermediate term turns. Pankaj asks, we only have SMA right now. Would we be adding EMA to it? Yes. But the difference between a 20 EMA and 20 SMA is really not much different at all. So you can go ahead and use this for now, but we will be adding EMA to it. We had a suggestion for Netflix. Let's go ahead and change this to, let's do 120. So we have the extension here. This tells you that, hey, maybe not the right time to buy, but then we get a pullback. We work off that extension, and then we've got the nice range here that you can use to profit from this. We are a little bit short-term extended, but this helps you prevent from adding up here or adding up here, and instead you're looking for the tight area, the pullback after the extension, That's a good way to put it. And again, base low right near the danger zone, back in here, base low near the danger zone as well after the gap down. So this can really help you both to the upside as well as the downside as well. RME will also be available in the Deepvue technical patterns. We haven't added it yet, but that will also be a way to use this indicator using the technical patterns indicator, just like we use with RMV. All right. Let's do MSTR here. So this is a really good one to show the difference between the different configurations. So this is with a 20-day 20-day moving average and then 100 look back period. If we change this to a 10-day and a 20 period look back, you can see the signals are a lot faster. It points out these more precise and short-term turns, and just helps you be aware that a pullback might be happening, as well as intermediate lows here and here on those pullbacks. So that's a good example of changing your configuration. You can figure out what works for you and your trading style. All right. Is the look back period key to the time frame of the chart you're using? 20 on a weekly? Yes. So on a weekly chart, we go to that. This is now based on a weekly time frame, and you can see we've been extended on the weekly from the 10-week moving average for quite some time, and that is actually showing power. But the daily is more for precise signals. But this also is workable on the weekly. You can see the tops correspond with those pushes towards the extension here at the top of the indicator. And we had a request for looking at what it looked like on Wednesday. So this is what it looked like on Wednesday. We're already extended 100%. So you're already aware that we're extended. And then the next day we get even more extended with the gap up. So we already had the warning signal here before the key reversal day. So I think that's pretty much what I wanted to cover today. We discussed sell rules, selling into strength, selling into weakness, the benefits of both. We discussed this indicator, how it can help you. So hopefully you guys got some great takeaways and know how to use this indicator that much better. So hopefully this was extremely helpful. That's our goal. And I do just want to reiterate that if you're interested in taking advantage of the Deepvue Black Friday sale, to email us at hello@deepvue.com or go to traderline.com/university for the Black Friday sale. And we do have that special offer today only now, with an extra $100 off the Swing Trader Masterclass with Oliver Kell. It's fantastic. He put his heart and soul in that, revealed his entire system, entry setups, sell rules. He discusses extensions quite a bit, especially in the first webinar, and how he deals with them. So if you want more information on that, highly recommend the Swing Trader Masterclass. It's a fantastic foundational class that can really help you, improve your performance. And especially if you're on the newer end, this should be a no-brainer. This will help you, build that foundation and build your own trading system. So thank you guys all for tuning in. Hopefully this was helpful. And yeah, all right. Some great thank yous in the chat. Thank you very much. Awesome. Hey, Wendy, how's it going? Good to see you. Hey, Joan, Rock, thank you guys so much. And yeah, this will be recorded and we'll post this next week as well. But thank you guys again for tuning in. Deepvue, we're working extremely hard to provide the best features, updates, all of that for you guys to make it the best trading assistant for you. And hopefully you guys are enjoying it and lock in some more years with Deepvue Black Friday. So thank you guys so much for tuning in, and I'll see you guys in future webinars. Cheers. Bye.